Today, let us talk about some introductory price action concepts again. What do you find out when you look at a chart? How do you define demand, supply, or support and resistance? Where do you expect bulls and bears to be present? So we will touch upon multiple such basic topics. With a touch of price action to it, and then I will show you how I analyze charts on a regular basis. I'll talk a little bit about that, and then we will see if we have time. Then we will talk about some more stuff. So stay tuned till the end. There is a lot of information that I will share. Traders at any level can look at price action concepts to re-understand what they are already doing or what they are already not doing. Right. So let's get straight into it. Please like, comment, and share the video. Let me know in the comments what you liked about the video, or if there are any other specific topics that you would like to be discussed. And please subscribe to the channel. If this is my chart, what are you looking at the chart? What information are you looking for in the chart? You have time on the bottom axis, and on the vertical axis, you have price. Right? So you are looking at the price of a specific instrument at a given point of time. Now the question is, why is price here at this given point of time? Price is here at this given point of time because the market thinks that given all the circumstances, all the news, all the possible information that is available in the market, given that this is the fair price of this item at this given point of time. Make sense? So it will continue to be in this state. It may go a little bit up, it may come down a little bit. It will go on in this state as long as the market does not think that, okay, the fair value has changed and we need to move to a higher fair value or a lower fair value. And that is when the market will move out of that range in which the market was thinking at that point that it is the fair value. Okay, so it is similar to your everyday life also, correct? So if you look at it this way, if you are buying, say, spinach from somewhere, so there will not be a huge difference in price whether you are going to Food Lion or you are going to Stop and Shop or you are going to Harris Teeter. There will not be a big difference in price among these, right? It may vary by 10 cents, 15 cents, depending on the store, but it will be in that range. What does that mean? That means the market views that the price of spinach, given all the other things are remaining constant, the price of spinach is this particular price at this point of time. Right? So similarly, this is the exact thing that happens in the market also. Okay. So this, what we are looking at is the daily, the 24-hour time frame. Now let me talk about time frames on a chart and what we look at. So when you trade futures or when you trade anything on the continuous market, there is something called electronic trading hours and something called regular trading hours with the US context. Okay, so how do we define that? Let me open an Excel sheet. So market opens at 6 p.m. every evening. Okay, from 6 p.m. to 9:30 a.m. this period is called the Globex or the electronic trading session. This is till the time the market opens in New York. Okay, so let us merge this. Let's bring it here. Okay, and then comes the regular trading session. Now the regular trading session starts at 9:30 a.m. EST and ends at 4:15 a.m. EST. Okay, and the market finally closes for settlement at 4:15 p.m. EST. And the market finally closes for settlement at 5 p.m. EST. And then On this day, the market reopens again at 6 o'clock. So 6 p.m. to 9:30 a.m. this is called the Globex session or the electronic session, and 9:30 a.m. to 4:15 p.m. is the regular trading session when the US market is open. For retail traders and retail investors, this is called the regular trading session, and the market settles at 5 p.m. Between 5 p.m. and 6 p.m., you cannot place any order, you cannot trade, the market is closed. Okay, so this is how we define the Globex session and the regular trading session. Now, what I practice and I teach is called price action. Now, what is price action? Price action is nothing but the relationship of the price with respect to the time on your chart. At what point of time? Where is the price? If the price is there and the price is moving in a certain direction, there is a reason for that. And the charts will tell you that. You can find out places where bulls are waiting. You can find out places where bears are waiting. So there are different ways you can find these things out, right? That the way to find that out, there is a practice. There are some best practices, there are some rules, there are some specific ways to trade at specific points of time in the day, and that is how you define what price action is. Price action is fractal. All the rules that we talk about, all the parameters that we talk about, it is fractal. You can use it on any time frame. You can use it on daily, you can use it on 24 hours, you can use it on 5 minutes, 4 hours, 1 hour, any chart. On any chart, the rules stay the same, and there is no change to it. Now, the only thing that you have to remember is, if you are trading a 5-minute chart, you cannot put a stop loss based on the 1 hour chart, right? Or you cannot take profit based on a 1 hour chart. You have to see if the logical take profit on the 1 hour chart is matching with what your 5-minute chart is telling you at that given point of time. If yes, fine. But if you are trading a 5-minute chart, your stop loss cannot be on a 1 hour chart. If you are trading a 1 hour chart, your stop loss cannot be based on the 4-hour chart. You can do it. I'm not saying that you should not do it. You can do it. But then your account size has to be big enough to be controlled in that time frame so that you don't blow your account out. Right? And so let us talk about support resistance. Or before support resistance, let us talk about some concepts of economics called demand and supply. You must have heard about it, right? So demand and supply defines the fair price of a particular item in a market at a given point of time. Correct? So if the demand is more and the price is in short supply, or the supply is the same and the demand suddenly increased, that increases the fair price of that particular item. On the other hand, if the supply remains the same and the demand reduces, say for example the demand of electricity during winter reduces because we are not running our ACs and most of the heaters are running on gas, right? So at that point of time there is a price adjustment in the electric unit cost, right? So if there is, the supply remains constant and the demand goes down, that will bring down the fair price of that particular item in that given marketplace, right? In a similar way, as I said, that market moves from one zone to the other, right? One fair price area to the other fair price area. So what happens is, where is the box? Say you have a fair price area here. Let's see some real life examples on a 5-minute chart. Okay. So if you see here, there are some bars right here which are moving sideways, right? It's not upward, it's not downward, it's moving sideways. The overall trend is bullish, right? So this is a area where the market has decided, okay, this is the fair price of this item at this point of time. This is the fair price. Okay. And now if you look above here, you had another brief period of fair price. Correct. Now see what is happening. This is one fair price level. This is another fair price level. Correct. Market thought that at this point of time, maybe some news came out, something came out, there was something happened in the market or in the global economy, anywhere. Market thought that, okay, the fair price is not here, the fair price is here. If I look to the left again, I will see this is another area of balance. Correct. Now see, why did I say market moves from one balance zone to another balance zone? There is a push out of a balance zone, right? Once the push is out of the balance zone, most of the time the push goes to the next balance zone, and if that is exceeded, it goes to the next balance zone. See, this is how price moves. And for a particular instrument, there are certain number of points at which bulls or bears take profit, right? So for ES mini, this is ES mini, which is the futures of SPY. People use 10 points, 15 points, 20 points. So there are certain rules based on which these points are used for capturing profit. So for example, if you see from this low of this candle, from this candle's low, if I measure, bulls actually got 70 points, right? And this is on a 5-minute chart. But it went up there. We had the previous balance zone. Now this is already telling me that, okay, this balance zone may not be crossed over. We will be getting stuck in this balance zone, or we may actually come down. See what happened. We tried to come down here. We went back up. We tried to sell off again. Now see, it got stuck exactly at the balance zone. You can short below this candle. Your target, your first target will be this balance zone. You came to this balance zone, you take most of your profits, you hold a runner. Now when you hold a runner at this point of time, you have moved your stop loss to a little bit below break even, so that you do not lose out the whole thing. If it decides to trade in this range now, that can also happen, right? It can start trading in this range at this point of time. So you will keep a stop loss below break even at that point, so that your profit, some of your profit is secured. But you have taken most of your profits here. Now what happened? At this point of time, you will say that, okay, if this is a trading range, if this is my trading range, this is my 50% area, this is my lower 1/3. So how we define a trading range is, if this is your trading range, this is the upper 1/3. The upper 1/3 is the sell area where bears are sitting. The lower 1/3 is the buy area where bulls are sitting. And this is the 50% line, right? So if you see here, if this was in a trading zone in this area, then we would not have come down below this double bottom, right? We had the double bottom at the exact 50% at the exact bottom of the trading zone here, and then we broke it. And once we broke it, again, see, this is the push. This is the push that the bears created to come out of this balance zone. And then the next candle is showing me that, hey, the balance zone is actually holding there. We have come out of it. This is the push beyond the balance zone. This is the follow through beyond the push. At this point of time, we know that even if we go up a little bit, we will come down to this balance zone. And so now at this point of time, this whole thing has become my trading range. And then when it starts going up again, I will try to see that, okay, maybe we are trying to go up there again. Right? But then my fibs will change at this point. At this point, my fib will come down here. So now I'll have to see what is happening at the 50% area. And if we are staying above the 50% area, we know that we are going somewhere back up to this place. Did we go? Yeah, we finally did. But okay, we came down first and then we went. See, so in this little area, we found three zones of balance. And is this in this three zones of balance, whenever price tries to come down again, it will come and hit those three zones of balance. When you are when you are doing your analysis on your chart, it is very important. Okay, there are different things that different people follow, right? Some people follow balance areas for support and resistance. Some people say there are order blocks. Some people say there are body gaps. Some people say there are fair value gaps, right? In the context of price action rules, we talk in terms of body gaps, not fair value gaps. We do not consider wicks as part of the gap. Number two is we consider the market structure, how the market is getting structured, and based on all those things, we decide whether it is a bearish market, whether it is a bull flag, whether it's a bear flag. That is what we decide based on that, right? And some people may use actual support and resistance areas, like they will say this is support. Yeah, this is support. But then there are people, I am one of them, who goes by body gaps. What is a body gap? This was the balance zone. Price is getting pushed out of the balance zone. This is the body gap that I created, right? The body gap got retested once, twice, thrice. You buy on top of this bar. This is a very solid bar. And then you look for a 1:1 of this whole move. At least a 1:1. And see, you got it there. You got more than 1:1 actually. So even if we include the wicks, I think we got 1:1. Yep, with the wicks also we got 1:1. Right. So this is how you find your you try and decide where your bulls are, where your bears are, where should I place a trade, should I place a stop order trade, should I place a limit order trade, what should be my take profit. So those things should be defined. Once you are in a trade, you have to define this is where I will take profit, and more importantly, you have to define this will be my risks. I am not going beyond this area, otherwise there will be problem in my capital, right? So those things have to be logically fixed and placed in your mind, correct? And then you take your trades accordingly, you manage your trades accordingly. If you think that okay, it can bounce very close to my stop loss and then bounce back again, okay, you can take one more contract or one more trade at this level in addition to the one that you had taken at the top, but don't change your stop loss. Now if you're pulling your stop loss down and you are high on hopium that okay, I hope that the price will go up, and you are moving your stop loss down, your loss will start to increase exponentially now, right? So there is no point in doing that. So find out the logical place where you should take your stop loss. Take your stop loss. Respect the decision that you already made. Okay. In trading, we say there are 3 P's in trading, right? One is patience. You have to be patient. You have to wait for your structure to form. You will have to wait for your confirmations to come, and then you will enter a trade, right? Next is perseverance. Think about tennis players, right? I heard this from one of the, if you have read the book, The Best Loser Wins. Yeah, The Best Loser Wins by Tom Hoogard. Tom Hoogard was one of the speakers in the conference that I went to over the last 4 days. And he was talking about tennis players, right? So say a tennis player is down 2 sets, right? And then finally that person comes out and emerges as the winner. That guy, starting from the third set, he is still playing his best shots. He's still trying to rectify what he did wrong in the first 2 sets. But he's not letting his mind get bogged down by the fact that, hey, I have lost 2 sets. He is still continuing, he's persevering in through the process. He knows his game, he's persevering through the process, he's playing the shots as and when it comes. He's not trying to repeat the mistakes that he committed in the first two sets, and he finally wins the game, right? So perseverance is another thing. You may have made one loss, two losses, three losses, but when your setup comes, now you have to define your setups. This is my setup. When your setup comes, you need to take the trade. At that point of time, you cannot say, hey, I did not take the trade because I was now afraid that, like the previous three times, this will also fail. You cannot say that. You have to take your setups, you have to take your trades, and you will have to respect your stop losses. If your account is small, trade small. Make sense? And the third one is the most important one, which is preservation of capital. Right? These are the three P's of trading. You need to have patience, let your structures form, get your confirmation. You have to persevere. You cannot hold yourself back from taking a trade when it is presenting itself to you. And you need to manage your stop loss in order to preserve your capital. So now let me show you what are the different ways we draw support and resistance, like the way I was saying, right? So you already saw this. This is my bull gap, right? My bull gap has been created. See, it is from this body, the body of the top of the body of this candle to the bottom of the body of this candle. As long as a bearish body does not come and close below this, my bull gap stays open, irrespective of the fact that the wick comes down till here and then goes back up. My bull gap is still open. If that happens, I will still consider that we are in a bullish market. Because of this rise, we will see the market go up a little bit more. Okay, that is the thought process that goes into this. On the upper side, if you see here, this was the bear gap, right? Now the market here is still bullish. Why? We created the bull gap. We have closed above the bear gap. We have got follow through above the close. So that means this bear gap is now done, right? And now we have 1, 2, 3, 4, 5, 6 bullish bars in the same direction. This is called a micro channel, where a micro bullish channel is a channel where none of the bars have crossed even by one tick below the previous bar's low. Okay, and it has continuously created higher highs. That's a micro channel. So such kind of a micro channels normally gets you a second leg up. So as long as you do not see consecutive bear bars making new lows, you cannot short it here. The market structure is still bullish. We got one leg up, down, second leg up, and then we entered into a tight trading range. Now, if we want to find out why this tight trading range is happening here, the reason for that can be found. If you want to investigate, you just see, okay, where was the last bearish body gap that we had? Draw it. Okay, this is the last bearish body gap. Or if you say the body gap has come till here, and see, this is where it got stuck. Right? So we are now in between, forget this, the bearish gap is now gone. We are now between these two body gaps. Right? We are between these two body gaps. The market is bullish for me. The overall market is bullish. I will not short as long as this is taken out, or I see consecutive bear bars coming down. Then I will start thinking, okay, we can get a lower low. Look here, one green bar, one red bar, another green bar, another red bar, another green bar, another red bar. There is no consistency. The market is now in a balance zone here. Now the market is saying that we are in a balance zone and we will stay in this balance zone as long as there is not a catalyst. That may be anything. That may be JP Morgan suddenly got a high net worth individual who wanted to put $50 million in the market, and JP Million went long on ES Mini. Right? That is also an event. You don't know that. I don't know that. But as soon as that happens, The supply was there, but the demand suddenly went up, the price shoots up. And that is when we will have to see that, okay, are we making consecutive highs? Are we making consecutive lows? The reverse may also happen, right? One of the HNIs wanted to sever all relationships with JP Morgan, or someone wants to pull out their complete investment. They liquidate the position. And if it's big enough to hit the market, it will hit the market. And then we will find consecutive bear bars coming down. Then we will have to read the structure. What structure is it creating? Did I go down enough to expect a second leg? That is what you need to ask. And most of the time, if a gap has been created, you have a second leg. Okay, this is the gap finding process, how to find a gap, and then you can do you deal with support resistance based on that. Now if I look at regular support resistance stuff, how people do it. So the market came down till here. This candle was bearish. The beginning of this candle was still bearish. It opened a couple of ticks below the close of this candle. It came down till here, and then the bulls took it up. Correct? This is exactly what happened. And then some bulls may have taken profit here, or some bears are selling here and trying to come back to this low so that the bears who sold here come out at break even. They broke even here. So if you want to see that on a fib, bears who sold here, they sold the top of this bar again, and they got more than break even, and then the bulls took it up. Right? So based on this, I would say this whole area is bulls now. This is my big support. This is my big support. It's a major support because it happened below this. There was a breakout, and it made the breakout fail and go back and create a new high. So this is a major support for me now. Breaking of which, after this breaks, now once we are below this body gap, it does not immediately mean we short, right? That may be just a liquidity dip into the area and the bulls will bring it up. So we'll have to wait for the structure. You will have to expect that, okay, bulls will be here again because we had such a nice high. If it comes down here, you will, if you're in your short, you will hold your short as long as you do not see the bulls. But when you see the bulls, you should not be in your shorts anymore. And the price action, the candle structure will define that. Once this breaks down, then we will have to come down to the next area of balance. See, this is the next area of balance where most of these candles were going sideways. Right? So if this breaks down, once this breaks down here, this is the next logical area where the market should come. But then if this breaks down and then goes back up and sits here again, you know that the breakout has failed. If you are still holding on to your shorts, again high on hopium, you need to see someone then. Okay. Is the balance zone considered? Yes, the balance zone, whenever the market is in a balance zone, that is the fair price, or that range has been decided as the fair price of the market at that given point of time. Make sense? Any questions? Okay. Okay, so now let us look at how we start analyzing charts, right? Now let us look at the monthly chart first. So this is the beginning of the month. You have just started. We are looking at the monthly chart. If you see here, what are the points of interest that we have, which we call POIs? My first POI will be here. What is this? This is the close of the previous month, and I will this is very thick. Okay, I will mark this as COM. Okay, close of COLM, close of last month. Okay, that is there. What is my next one? My next one is here. This is my high of last month. HOLM. Okay. Then what do we mark? Then we mark the low of last month. You don't need to consider the open of the month. That is not necessary. So this will be LOLM. Okay, and you will mark your open of your month. This is opening of your month, OOM. And you know this is the high of your month, and your current price is your current price. And you will mark this as well, the low of the month, LOM. Okay, makes sense? Now what do we see here? We see here, this was the balance zone. Agreed? See, same concept on every time frame. This is the balance zone. Let's draw the box around the balance zone. This is my balance zone. Okay, I did a gap up opening and pushed out of the balance zone. What did I do in the process? Now I'm removing the balance zone. We will draw the body gap that happened here. The body gap happened here. After this body gap happened, they gapped up, they went up. This was your first signal to buy. We had a pullback. We came down below the body gap, but we did not close below it. Right? We did not close below it, and as soon as that happened, we started going up back again. Right now, this is the last body gap that we have, correct, on the monthly chart. On the monthly chart, we cannot say that we have become bearish as long as this body gap is not taken out. But this is too far away. I will have that body gap concept in my mind. Right now, these are my points of interest, but I will remember, I will have this marked in my chart that, okay, this is where the body gap ends. We came down there, went back up here. So something may happen here. Or the next few months may be like this here, creating another balance zone. That is also a possibility. Right? But looking at this monthly chart, nothing can tell me that there is any bearishness. Correct? Agreed? Okay. Now, let us remove all these things. Remove indicators, remove drawings. Let us go to the weekly chart now. So one time frame down. On the weekly chart, what do we see? We had a micro channel. In the beginning, I said what a micro channel is. We had a micro channel up. We had another micro channel up. Now, if you see, we started from here. We came up to here. This was the first leg. Yeah. Okay. So here we are, right? On the weekly chart, if this was my first leg, I am saying that the target for the bulls is here. They want to get a 1:1 of the whole thing, right? And if you see, we came down, when we came down, we came below the 33% area, which is the upper 1/3 of this whole move. Once we came to this 33% area, we straight went back up. We did not hold below it on a weekly basis. We did break below that. There were bears who were waiting below this line, below the low of this bar in order to short. People were there. But their order never got executed because we never came back. Instead, we did a strong inside bar followed by, now see what is happening. You have your bear gap here, correct? Now, let me change the color of this major bear gap. Okay. Now, you created a bull gap here. You created a bull gap here, right? Since the market was bullish, okay, since the market was bullish, you know that, okay, it may actually, that is your assumption. That is the assumption that you are doing. That is, the market is bullish. We have created this bull gap now. If I buy here, there is a bigger chance of getting a profit rather than losing out first. And it continues, right? And then if you see, if this was the breakout attempt or the breakdown attempt by the bears, and the bulls have closed above this, if the bulls close above this, let's be conservative, let's end here. The bulls have actually closed above this. It came back, it tested the gap area, and we went back up again. So at this point of time, I can say that, okay, if this is where the bulls started buying, and if the bulls are actually trying to go up, this may be the target. Now again, that is still too far. As we now we have a bullish intent, we know the market is bullish, we get a new high, we will continue. Correct? So we will play in that way. What happens here is a different story. What we are saying right now is the market has the ability to go up to this level. That's what we are saying. But again, we may form a TR here, a trading range, a balance zone. Anything can happen. Right? So then we come down to the daily chart. Now the daily chart. Let's see what happened in the daily chart here. Let's remove all the drawings. Okay. So when the drop started, this was my first bear gap. Correct? We, instead of retesting it, we closed above it. We got kind of a follow through, but then we had kind of a double top, right? So this is a double top, higher high double top. We had a double top. We came down here. You could have shorted below this. Now you can say that, hey, so this bear gap was destroyed. I will say yes, the bear gap was destroyed. If you say that, okay, we had this candle which went above the bear gap, and if you consider this a follow through, the bear gap was destroyed. Okay, fine. Let us remove it. We will delete this bear gap. What happened next? This is the final bear gap that got created. Correct? Now see, when we came back here, bears did try to sell. It's a different story. They were not successful because after this long climb, they were not successful. Right? So this is my bear gap. This was the last bear gap that the bulls have taken out. And what held the bulls here? If you see, this is the bull gap that has held the bulls here. This is the whole bull gap that has held the bulls here. This is the daily chart. So here also, I am saying that, okay, this bull gap is not being taken out. This is a micro channel now getting created. We have created higher highs for 1, 2, 3, 4, 5, 6 days. If the market still continues to go up and we do a measured move from here, from this, if we are saying we are breaking out of this, 5487 is my new target. Right? So if you are playing options on the daily chart, you can buy a 5500 or a 5400 call based on this assumption. Right? Also, if you look here, this is where they started selling, and this is where they started buying back again. In that case, if you say this, if I need to go above this in order to say that I will reach somewhere, this is your next level of target. I'm not telling you take such kind of targets on the daily trade and keep your position open. I'm not telling you that. I am telling you a process. I'm showing it to you on the higher time frames now because it is more clear, right? So that to make you understand. This is the same process that you follow in all the time frames to get to your stop losses and to get to your take profit areas. Make sense? What would you call your strategy for trading? If you have a name for it, no, I have rules. I have rules which have been defined by a gentleman called Al Brooks, who is my mentor, and I follow those rules. Along with that, there are certain things that I have learned from different other mentors or mentees of Albrook's who also are my mentors. There are certain tricks that I have learned from other sources also. But and then I have created a certain style for myself. Like I said, fair value gaps, I find body gaps to be far better than fair value gaps. That is how I look at the market, right? So I have taken all these things, I have made a combination of all these things, and based on that, I see what is happening, what is not happening. But yes, the teachings of Al Brooks have a major influence on how I trade. Let us see one more time frame before we close, right? Now, in this time frame, it is telling me a different kind of a story. Now, if you look here, the 4 hours is telling me a different kind of a story. Now, this is the RTH version. Let me go to the ETH version. What is the 4 hour telling me? Right now, in the 4 hour chart, I have certain sections. Okay. If you see, this is one section which is a trading range by itself. This is another section which is a trading range by itself. Let me change the color a bit. And then this is another section which is a trading range by itself. Correct? So on the 4 hour chart, we have a tiered trading range. Correct? If we come down here, if we get support here, we will mostly get to the top of this range. If we get rejected here, we will come down to the bottom of this. If we break this down, we will come to the bottom of this. And then we decided, okay, this was my balance area. This was my balance area on this. This was the balance area. Okay, it is creating a balance area now. That was just a straight reversal. Okay, so this was the top. We went back to the top. Okay, first attempt, second attempt, third attempt, it went up. So now these forms your major support and resistance areas, the edges. All these edges also now form your major support and resistance areas, which you need to take a look at. You need to remember, you need to have them marked on your chart. You need to keep reminding yourself of this. Now, I could have drawn it a little bit better. It is not very accurate at this time, all the trading ranges, but you can get an idea of what I'm trying to say. Right? So these are the 3 stacked trading ranges that we have. And many a times we have seen that these stacked trading ranges continue to be in this particular range from the top to the bottom for weeks together. Right? I have seen consecutive 11 days or 12 days of price action that has been in a level of stacked TRs. What time frame do you mostly use for analyzing? Okay, all these time frames that I'm showing you, I do my analysis on them every night. Right after this call, I'll sit down to do it. Okay, so I start from monthly. I have already marked. There's nothing to see. Weekly, I have already done on Sunday night, so there is nothing new to do about it. I will start from the daily chart, see what has happened on the daily, make my levels, mark my levels. Then I will come down to the 4 hour chart. I will mark my levels. Then I'll go to the 1 hour chart. I'll mark my levels. And then I will go to the RTH intraday 5 minutes chart. I will mark my levels there. Based on those, I will find out my areas of confluences between all these levels, which are the strongest levels that I am looking at. Based on that, I will make my trading plan. Once I have made my trading plan, I will stick to that plan. My plan will actually define, if I enter here, this will be my stop loss. And I always stick to my plan. If I have to take a stop loss, I take it. Okay, so discipline is the key to this business. If you're not disciplined, if you cannot control emotions, this is not something for you. Make sense? And I'm not saying that you cannot get to that. You can get to that. You have to concentrate. You have to persevere. You have to keep studying. You have to keep reading. What do you recommend we read? Okay, I will tell you. Go to Amazon.com. Good. Look for Albrook's. Okay. Book number 1, book number 2, book number 3, book number 4. These are the 4 books that you have to read. Okay. In the order of start with trends, go to trading ranges, then do reversals. Once you are done with all 3, then you read this book. Okay. Apart from that, one more book. This one, Japanese Candlestick Charting Techniques, second edition. This is another book. So what I do is I do not go by what is called a pin bar or a spinning top. I do not go by those. Okay, what I go by is how the concept that are explained in this book, how is it matching up with my strategies? How is it matching up with the knowledge that I have about price action? And that is how I use it. Okay, I do not go by the rules that has been mentioned here. I go by the explanation, that the way Steve Nissen has explained that this is why this bar is happening. Now I bring it down to my price action basics and try and understand, okay, what is going on. Okay, apart from this, mentality or psychology is a big part of trading. Now, if you look at my server here, yeah. So these are the books that were suggested at our conference, right? The Inner Game of Tennis, Trading in the Zone. There's a book by David Paul, and then Best Loser Wins, and then Trade Mindfully. So that's all for it from me for today. And hopefully, I will see you guys back again in the next session. Bye for now.